All right, welcome back to another video. My name is Ian Major. I'm an entrepreneur, investor, and all-around raging capitalist. And in today's video, I'm going to go into the anatomy of money printing. We're going to dispel some myths. A few of you have asked about this as a video topic, and so I'm happy to be doing this for today. And this also harkens back to a video I did very early on in the channel around this kind of perennial debate around inflation and deflation. On the inflation side, I think it's pretty clear. Everyone kind of sees these news headlines around, giant stimulus packages and money printer go Brrr, right, has become the meme of arguably, 2020 and beyond. And so that's kind of intuitively clear, although as we'll discuss, it's not as easy as that. But then, believe it or not, on the deflationary side, there's a number of key factors at play, including technology, right? The inexorable growth of technology, which is an inherently deflationary force. And then also demographics. There's a lot of developed nations in particular that have, a big portion of their population that's kind of in the process of retiring. In the US, for example, would be the baby boomers. And so as you're going from kind of working age into retirement, you're going to naturally spend less. And so both technology and demographics can have a dampening effect on prices. But I figured it was time to kind of do a bit of an update on that theme. And as part of today's video, what I want to do is a few things. One is go into how Treasury auctions work. So how, in the case of the U.S. Government, how they issue new government debt into the market. We'll then cover QE, quantitative easing, how that works. How the central bank kind of comes in and monetizes that debt that the government has just issued. And then finally, we'll talk about how the outcomes differ significantly depending on whether we're doing just QE or QE plus fiscal injections, which we'll talk through. And then we'll end the video with some observations on some of what's happening currently in terms of inflation expectations going forward. So it should be a great video. If you're not already subscribed, go ahead and hit the subscribe button. And without further ado, away we go. Let's dive into how Treasury auctions work. I've come over to treasurydirect.gov. And I'll link this and others in the description down below. Again, this is kind of US centric, but structurally works very similar in most other nations. And so you'll kind of see, there's three components to this. There's the announcement. So there's basically a schedule. You can see when different Treasury securities are going to be auctioned. You can see the different types of securities. So for example, you've got the bills, which are a shorter duration, up to 52 weeks or a year. You then have Treasury notes and bonds. And so, this ranges anywhere between a 4-week to a 30-year bond, right? And, some of the more popular rates or yields that you'll see, the 10-year, as well as the 30-year. And then there's some other securities here at the bottom. So all of these are announced to the public with the following information, the date of the auction, the amount of the security being issued or offered, when would the securities themselves actually be issued, their maturity date, et cetera, et cetera. And then it has some information around the bidding process. So there's competitive bidding, non-competitive bidding. I won't go through this for purposes of this video. But basically all the different kind of entities that are potentially bidding are doing so through a Treasury Direct account, or if they're institutional investors through this TAPS program. And so this could be a wide range of organizations that are doing this. Could be individuals, right? I mean, like you could literally go on and bid for treasuries. Also, corporations, estates, trusts, and other, financial institutions. And then finally, you have the actual issuance. So on the issue day, the Treasury will actually deliver these securities to the bidders who are awarded the highest bid. And then the Treasury gets paid. So there's kind of actual cash that the Treasury gets. And that's really it, right? So, I mean, this is, you say Treasury auction, it sounds highly kind of sophisticated, but it's really relatively straightforward, at least structurally. So in the year 2021, everyone has heard of quantitative easing, or QE. This has been around for quite some time, since the great financial crisis, and even well before that in certain economies and nations. And essentially what this is a central bank going in and buying up large amounts of government debt. In the case of the US, what that looks like is the Federal Reserve, which is the central bank in the US, buying up the US Treasury securities that we were just talking about, and also mortgage-backed securities. And it's doing that in order to try and buoy the economy. The idea being, if we go out and buy large quantities of the treasuries, that creates a heightened demand, and also by purchasing those, you're kind of effectively reducing the supply of those securities in the market as well. And so all of that pushes the price of those bonds and those different treasury securities up. And for a bond or a piece of debt, the interest rate is inverse to the price. And so heightened demand pushes price of these treasury securities up, and therefore pushes the yield or the interest rates down. And the idea is that by pushing interest rates down, we can hopefully stimulate the economy and encourage more borrowing and more lending from the commercial banking system. It's important to note that Federal Reserve in the case of the U.S. has been conducting such open market operations, as they're called, for forever, right? And they do this to try and fine tune short-term interest rates, as this nice kind of piece is describing. I'll link this in the description down below. And essentially, QE is just doing that, at a much greater scale, right? And QE in particular also tends to focus on longer maturity debt, so that kind of 10-year, 20-year, 30-year securities. And in terms of the actual mechanics, let's click into this very helpful diagram. I think this captures it well without losing a ton of nuance. But in the last section of this video, we were talking about the Treasury issuing Treasury debt at auction, right? And so that's what's happening. The different institutions, you have these primary dealers, which can be banks and other kind of entities, are exchanging cash for the debt from the Treasury. Then what happens is the Federal Reserve is buying that debt from these financial institutions. And so what they're doing is they are taking those Treasury securities and putting it onto their balance sheet as assets. And then it's also adding to their liabilities additional bank reserves. And so those bank reserves are, think of them as liabilities from the Fed to the commercial banking system. So there's not literally money, going from the Fed over to the bank, let's say Morgan Stanley. What's simply happening is that the reserves that Morgan Stanley has at the Fed are being increased by the amount of the treasury securities being purchased by the Fed. And so that's important, right? Because the next step is really what matters. All that's happened at this stage is the Fed has created bank reserves, indeed out of thin air, but essentially it's just been an asset swap. They've increased bank reserves out of thin air and have taken the Treasury securities onto their balance sheet. Now, the idea, or what the Fed and the government hope will happen, is that the commercial banking system will then loan out more money into the actual economy. That's the whole idea, right? By having these excess cash reserves. However, what has been observed over time is that that isn't necessarily the case. The commercial banking system may or may not actually go ahead and kind of loan that out, depending on the broader context, the credit worthiness of borrowers, etc. And so this process begs the question, what impact has this had on the economy? Well, it's certainly the case that QE has decreased interest rates and pushed them artificially low. But beyond that, the results are at best mixed, and at worst have dramatically contributed to, inequality and challenges and unrest that we're seeing both in the U.S. and globally. And so it all comes down to this next visual, which is very nicely put together. I first saw this from Lynn Alden. I'll link her Twitter in the description down below. But what this is showing is three different measures. In the blue, we're showing M2 money supply. So this is basically the currency unit circulating in the economy, in this case, the U.S. The red line represents the total assets on the Federal Reserve balance sheet. And then the green line represents government current transfer payments. So these are things like, welfare, any kind of direct fiscal injection where the government itself, not the Fed, the government is putting money into the hands of citizens. So kind of the, different stimulus checks would fall into this category. And what we can see is really striking. The first three rounds of QE. So here's QE1 with the Great Financial Crisis. Here's QE2, QE3. Here's even in 2018 where they started QE tightening, i.e., reducing the size of their balance sheet. And then markets did not like that, so they went right back to it. And then that gets us to 2020 and COVID, where it just shoots up parabolically. But what we can see in these first waves of it is that it really doesn't lead to a commensurate rise in the M2 money supply. And what this basically means is that QE alone has tended to stay in the banking system. And it's gone into financial assets like bonds, like stocks, etc. And so this is why those individuals who have assets have seen their wealth appreciate at roughly the same rate as central banks have been printing money over the last more than a decade. And then conversely, folks who don't have assets, who have just a fixed wage that they're living off of in terms of income, they've felt like they're falling further and further behind in terms of cost of living. And so this is why QE is directly contributing to that issue. But when we look over all the way to the right, when you combine QE, i.e., the central bank monetizing the debt of the government, and you have the government kind of spending money in concert, so there's more and more coordination between the Treasury, i.e., the government, and the Federal Reserve, the central bank. When you have that coordination, we're seeing the commensurate rise in M2 money supply. And so this is the key. QE alone doesn't necessarily drive inflation. It drives asset inflation, that's for sure. So anyone who says, oh, there's been no inflation, that's completely false. There's been a tremendous amount of asset inflation while QE alone has been happening. But in terms of like broad-based, the meat at the grocery store type of consumer price inflation, that really hasn't ticked up until you start having this combination of both QE and the government directly injecting money into the economy. The other factor that, of course, matters when it comes to will we see inflation or not is the velocity of money as well. And so if I go over to this other view, this is directly from the St. Louis Fed, the database that they keep, velocity of M2 money stock. So this is basically measuring the velocity or rate at which currency units in the economy are kind of changing hands. And as you can see, it's gone down, significantly with COVID. It's popped up a little bit, but is still just historically low, right? And this is largely due to the restrictions, the lockdowns, the fact that people can't go out and kind of spend money. And so while this remains so historically low, we may or may not see a dramatic rise in inflation. But as we'll cover next, we're starting to see some of the signs that could suggest markets are really anticipating higher inflation in the near term. the verdict? We've basically seen that QE alone doesn't necessarily lead to broad consumer price inflation in the way that you might imagine thinking of Jay Powell kind of cranking up the money printer, right? All it's really doing, all QE is really doing is it's increasing bank reserves for the commercial banking system with the hope that they will kind of loan that out and stimulate economic activity. What we've seen over the last decade plus is that that hasn't really been happening for a variety of reasons. And so what's happened is all those extra bank reserves have kind of been stuck in the banking system and have instead gone into financial assets. So we've certainly seen financial asset price inflation, but we haven't necessarily seen as much kind of broad consumer price inflation. You couple that with the fact that the velocity of money is way down, and that kind of gets us to this idea that we haven't yet seen prices go through the roof, but the market, very interestingly, is beginning to become concerned. Right? If I flip back to this, I mean, the rate at which the M2 money supply is going up is truly extraordinary. Right? I mean, this is unprecedented, and the rate that is going up. It's only a matter of time before vaccinations become kind of broadly enough available, economies start to kind of reopen. Once that velocity starts to actually pick up, things could get really interesting really fast. You've seen different headlines come out around lumber prices being just stratospherically higher year on year. You've seen meat prices begin to go up, and so there are real signs of kind of proper consumer price inflation going up. And keep in mind, this is a totally engineered measure by the government to to underplay the amount of actual inflation that's going on, right? As we talked about, there's asset price inflation, there's inflation of healthcare, et cetera. But even in some of the CPI components, you can see these major categories here. This is right at the government website for the Bureau of Labor Statistics, which publishes the CPI. You can see that food is up 3.6% in the kind of 12 months as of February 2021. Energy is up 2.4%. So just think about food, right? Just think about food for a second. So food is up 3.6%. Do you think that everyone's income and wages are also up by that amount? Certainly not, right? Do you think people are earning that amount in interest on their savings in their bank account? Certainly not. And so what's happening is, even with the official measure from the government, it shouldn't be that hard to see that going forward, people are going to feel like their cost of living is rising. And this is true for folks who, again, don't have assets that are going to continue to appreciate as the Federal Reserve and government kind of pump more money into the economy. And what we're then starting to see is in Treasury yield. So this is the 10-year Treasury yield, which is essentially the return that will be earned on this security by holding it to maturity. You can see this is a kind of longer term view all the way back from 2016. You can see that it goes way down in 2020. And this is due to, all the kind of activity we saw as COVID was unfolding. But really, it's pretty rapidly ascended back up all the way now to 1.71%. And so this is essentially the market saying, you know what? I think there may be more inflation than you're leading on that there's going to be. And if that's true, why would I accept a lower return than the rate of inflation? Right? Like, I'm going to be losing money on a real basis. If I'm earning a 1.7% yield, but the true rate of inflation is 2, 3, 4%, right? I'm literally losing money in real terms. And so treasury holders and bond holders are waking up to this reality. And it's going to be really interesting to see. You've seen really horrible, sloppy auctions. There's been a lot of headlines on this recently where you're basically seeing lower demand for treasury securities. Foreign central banks certainly aren't buying them anymore and haven't been for years. And so it's really a question of, is the Fed going to have to continually step in more and more to prop up the bond market? Because what will happen if they don't is that demand will fall off, yields will go up, and the government can't afford that. They can't afford for interest rates to go up. The tax receipts, total tax receipts for 2020 that the government sucked in aren't even enough to pay for the interest on existing debt, along with the required pay-as-you-go entitlements. And so, for all intents and purposes, the U.S. government is essentially insolvent and has to print money just to keep up. Okay, so there you have it. So we covered a lot of ground there. We went into the kind of anatomy of how Treasury auctions work. We sort of demystified that process, and then we took a look at the process of QE and how the central bank comes into the picture to monetize the debt. But then we also saw that that creation of bank reserves out of thin air isn't necessarily going to then go and make its way into the real economy. And so as we saw in those kind of prior bouts of QE1 and 2 and 3, it pretty much stayed in the kind of financial system and didn't really go into the real economy. And the way you make the latter happen is by pairing QE, or the monetization of the debt, with actual new fiscal stimulus, such as the stimulus plans that we've seen starting back in March 2020. We took a look at how a lot of that's been offset, at least for now, by the kind of money velocity, given all the closings and restrictions in economic activity. I think we find ourselves at a very interesting point, given some of these converging forces, vaccines being rolled out, economies slowly kind of reopening a little bit more. So my bet is certainly on the inflation side. So there's a few things that are going to benefit the overall value proposition of Bitcoin more than this, because my bet is that the government, not just in the U.S. but around the world, will continue to prop up and support their economies. That's the most politically expedient approach, is to continue to debase their currencies, as opposed to actually letting the whole house of cards fall, which would create unrest and just many worse problems for these governments. So if you like this video, you already know what to do. Give this video a like. Again, make sure you're subscribed if you're not already. Lots more great content coming on the channel. And without further ado, we'll go ahead and leave this video here for now. As always, every sat counts. And until the next one, I'll see you then.